Go.
Hello, my name is Ken Moore. I'm with Anahuac National Bank. I currently serve as the president and CEO. Today we're going to talk about investing for beginners. But before we kind of get off into that, I need to do a disclaimer and tell you that I'm not licensed to give financial advice, and what we talk about today is strictly personal preference and personal opinion. It does not reflect the attitude or opinions of Anahuac National Bank, the directors of Anahuac National Bank, the employees or officers of Anahuac National Bank. To give you a little background on myself personally, I have an undergraduate finance degree from Colorado Tech. I have a graduate degree from Sam Houston State, both of them in finance. I've been in community banking since 1981 and currently the president and CEO of Anahuac National Bank since 1994. I've also been the chief investment officer for Anahuac National Bank, and I currently manage an investment portfolio of about $200 million. I tell you these things just to give you a little idea of that I'm not really a great investor, but I kind of understand the process. So today we're going to talk about that on a little more extended basis. So what is investing? Investing is the act of allocating resources, usually money, with the expectation of generating income or a profit. Many times over my career in banking, I've been asked, when is the best time to invest in the stock market? And it took me a little while to find this slide because I heard this many, many years ago, and I find it really true. The best time to invest in the stock market was yesterday. The next best time is today, and the worst time is tomorrow, because tomorrow never comes. And if this is something that you're thinking about doing or you want to do, but you're going to do it tomorrow, 9 times out of 10 that never happens. So I tell you, if you're going to do it, get your plan, your strategies in place, and get with it. Ken Moore's principles for investing. These are very simple, but they are true as the day is long. Like anything, life is hard by the yard, but life is a cinch by the inch. And what I mean by that is you have to take small steps in investing. Do not expect to walk in, first of all, $100,000 and put it in the market and hope to make money. You may, but if you take methodical, small steps, every pay period, every month, every quarter, whatever period of time you want to invest, and you do it over a period of time, you will make money and you will build a nest egg. When we focus on life as a whole, we can't master it. When we focus on big problems head on, we normally get overpowered to face them. When we focus on important life decisions, we kind of get stuck. The future apprehends, size overwhelms, and analysis becomes paralysis. Yet, when we approach problems and decisions by taking small steps, the solutions are slowly created and revealed. There's no sense in getting in a big hurry. We just take small steps toward the direction of our goals. Another way to put it that I've been told many, many times is, how do you eat an elephant? One bite at a time. Okay. So, if I could go back in time and change something about myself when I started investing in the stock market, I would make myself read. There is more information out there, especially today, than there ever has been. But if I would have taken the time to become more informed about what the decisions I made in the stock market, I think I would have done much better. Warren Buffett put it best: the more you learn, the more you earn. And I really do believe that. I think if we spent the time to become more informed, our success in whatever our endeavors would be better. People in general have no idea how much they're missing out by not looking at the ways to gain more knowledge on all types of subject matter. Knowledge is everything in this world. It is really pure power. If you can learn something new every single day, then you're actually improving every day of your life without even being aware of it. And it's true that new learning is what keeps our brain healthy and alive. So in investing, whether it's the stock market or commodity market or real estate or whatever it may be, you've got to determine risk versus reward. Because the greater the risk, potentially the greater reward. The less the risk, the less reward. Risk comes from not knowing what you're doing. So if you really don't know how to invest, and just to put money in the market, you're taking a big risk. One, on what you're investing in. Two, really, you're not sure why or what you're doing, and so it could not really work out real well for you. To get profit without risk, experience without danger, and reward without work is as impossible as it is to live without being born. You've got to take risk. You're going to have to get some experience, and you're going to have to work at it. But if you do those things, you will be successful. These are some terms, investment terms, that you probably need to know a little bit about. There's many of them, but these are the ones that I chose for this podcast. Investment, we've already talked about the commitment of funds to one or more assets that will be held over some future time period. Risk, the chance that the actual return will be different from the expected return. Passive investment strategy, a strategy that determines initial investment of assets and makes few changes over time. And I'm going to give you an example. So when our bank buys investments, we buy them and we hold them to maturity. We're not worried about selling them. We're not worried about transferring these assets to a different kind of asset. We buy them and hold them and take the earnings off that portfolio on a monthly basis. It's a very passive, very conservative strategy. Active investment strategy, a strategy that seeks to change investment assets in the belief that profits can be made. I'll give you an example of that. I'll give you an example of active investment strategy. So if you buy a stock, 1,000 shares at $5, you have $5,000 in the market. But let's say that a week later that stock goes down in value to $3. You can do what's called cost averaging, and you can buy another $1,000 shares for $3, but your cost now averaged is $4. When that stock goes back to $5, you have now built in a $2,000 gain. It's a very common practice. It's an active investment strategy, and it doesn't take a lot of money to make really good returns if you can average your cost if the price of the stock moves down or up. More terms to know. Direct investing, it's when you buy sell securities typically through a brokerage account. You have an investor, or you go to one of the brokerage firms and you pay them to do this for you. And indirect investing, and this is when it's a little more complex, but it's buying and selling the shares of investment companies that they hold in their portfolio. Warren Buffett said the stock market is a device for transferring money from the impatient to the patient. You've got to take your time. You have to know what you're doing. You have to identify your risk, and you have to be informed. Determining your risk tolerance. So how do I know how much risk I want? How much risk can you stand? And what is your time horizon to achieve your investment goal? This risk tolerance is very much like simply the way you would look at getting on a diet. So I want to lose weight, and I know I need to lose weight, but anyway, I want to lose weight, and you say I want to lose 20 pounds. How do I get there? Well, simple. You burn more calories than you take in, right? But how do I do that? Well, some people do it through exercise. Some people do it through diet. Some people do it through both. Investing is the same way in risk tolerance. How much risk do I want to take on? How much money do I want to make? And how soon do I want to make it? The quicker you want to make it, the more risk you want to take or have to take. More risk with long-term goals, less risk with short-term goals. It's very similar. The greater the risk a person is willing to make on an investment, the greater the potential return will be. Risk is generally divided in three categories. Conservative. This investor is comfortable with accepting lower returns for a high degree of liquidity or stability. Typically, a conservative investor primarily seeks to minimize risk and loss of principal. A good example of a conservative investment is a CD at the bank. It pays virtually nothing now, 1% maybe if you're lucky, but the risk of you losing any principal is zero, because even if that bank fails, the federal government insures that certificate of deposit up to $250,000. It's a very conservative approach, but there is no risk at all. The next level is moderate. The investor accepts some risk to the principal, but adopts a balanced approach with intermediate term time horizons, 5 to 10 years, combining large company mutual funds with less volatile bonds, riskless securities. Moderate investors often pursue a 50-50 structure. And then lastly is an aggressive. An aggressive investor values maximizing returns and is willing to accept substantial risk. This investor believes maximizing long-term returns is more important than protecting principal. You better know a lot, and you better have some money set aside if you're going to be this guy. I'm not saying you can't make money, but this is throwing caution to the wind.
Is that what a day trader is?
A day trader is just really somebody who's in and out of the market. A day trader watches a certain stock or a certain index, and if it goes up or goes down, they buy, and they're betting that it's going to go up. And if it goes up just a little bit that day, they sell and they make a little money and they get out. It's in and out real quick. Yeah. So this graph is really just showing you the risk-return relationship. Bank deposits, like we talked about ago, CDs are low risk. Public sector, that's like Anahuac Independent School District having a bond election, and they're selling, you're loaning them money to build a new school or whatever. Corporate bonds, mutual funds, equities, and then venture capital type stuff. So it just kind of gives you an idea of what is conservative versus what is aggressive. How do I minimize my risk? And this is very important, because minimizing your risk is going to take away the possibility of you losing money. Diversification is the key to the management of the portfolio risk, because it allows investors to significantly lower portfolio risk without adversely affecting return. Next slide, please. Why should I invest? Well, you want to retire one day, and when you do, you want to have enough money available to outlast your life. That's one good reason. The other couple of reasons make really good sense. Large purchases, to purchase a home or a car, and in order to do this, you really want to be a conservative or moderate investor. And then, of course, college education for your children or and yourself. Things to do before investing. So before you really decide to put money in the market, you need to sit down and put together a budget. You need to, and that's counting every item on the expense side that you can think of. And once you get to the net difference, if there's any surplus, divide it by 2. I would divide it by 2 and invest half of it. But you need to make sure that you have a good budget, because if you don't, you're going to end up using money that you've invested to help cover your expenditures that you didn't count on or didn't plan on your budget. The next thing is to pay off credit card debt. And I can't emphasize how important this is. Credit card interest is anywhere from 18 to 24%, compounded monthly, which makes this really, it's almost, it should be outlawed. But if you're spending 18 to 24% on credit card debt, that's money that could be used to invest in the stock market at maybe a 10% return. You really need to get rid of this before you even think about investing. You need to have a small slush emergency fund just for any kind of contingent situation. You need to have some health insurance in case sickness or something prevents you from working and you don't use your investment money to cover your medical expenses. You need to, of course, evaluate your risk tolerance profile. Make sure that if you're conservative, you are doing conservative investments. If you're moderate investments. And lastly, educate yourself. Education might be the most important factor in the early investing success. Benjamin Franklin said an investment is an education always pays the highest returns. What investments can I make? And this is just a real quick list of, you can invest in stocks and bonds, mutual funds, bank products, CDs, savings, money markets, options, annuities, 401ks at work, and savings plan like Texas Tomorrow and Texas Promise Fund for education needs. Excuse me. 10 common types of investments and how they work. Stocks are also known as shares or equities, may be the most well-known and simple type of investment. When you buy a stock, you're buying an ownership stake in a publicly traded company. Many of the biggest companies in the country, like GM, Apple, Facebook, are publicly traded, meaning you can buy stock in those companies. How can you make money? When you buy the stock, you're hoping the price will go up so you can sell it for a profit. Another investment option are bonds. Bonds are really, you're loaning an entity money. You're loaning the money to the school when they have a bond election and they want to build a new school, or you can buy government bonds. You're loaning money to our federal government. They're paying you interest. How can I make money? While the money is being lent, the lender gets interest payments, and it comes in on a monthly basis. The other thing that you can invest in is mutual funds, and a mutual fund is probably the most diversified option available. It invests in just an array of companies, and it can be, people say if I invest in 40 different companies, but they're all in the software industry, is that diversification? No, because if the software industry has a problem and creates a debacle, all those companies' value will go down. So what you want to do is you want to make sure that when you diversify, you have so much money in software, in trucking, in financial, in agricultural, in whatever. So, because the idea of all of those industries going down in value at the same time is pretty slim. So you have to make sure that you really understand what diversification is. And mutual funds is the best example of that. Retirement plans, it's 401ks. At the bank, we have a 401k that whether you participate in it or not, you are eligible to have 7% of your salary contribute to your 401k. So if you put in 10% personally and the bank puts in its 7%, that's 17% of your salary that goes in that 401k, which is in a mutual fund, which normally has a 10 to 15% annual growth rate. It is a very, very generous plan, and this is one of the best ways to take your investment money and make you money. So when you retire, you've got a pretty good nest egg. CDs, we talked about those. It's a very, very conservative investment, no risk to lose principal, but your return is very minimal. Retirement plans, it's 401ks, IRAs, 401(b) plans. Exchange traded funds, ETFs, they're kind of like a mutual fund. I don't really prescribe to this very much, but it is a possibility. I mean, it's an option that you can invest in. Next one, please. Options. This is for the aggressive day trader. So, without trying to be too complicated, if you buy stock and you believe the stock is going to go up, you can sell a call option. If it goes up, you're going to make money because you can sell that option and reap the benefit of that option, and you can also sell that stock afterwards and reap the benefit of that increase in value. But you can do the same thing with puts. If you think that stock is overpriced and it's going to go down, you can buy that stock in a put option, and it will protect you when it does go down, and you'll make money. But it's a very complicated, super aggressive option in investments. Annuities. Many people use annuities as part of their retirement savings plan. When you buy an annuity, you purchase an insurance policy. In return, you get periodic payments. They come in numerous varieties. I don't have a lot of experience in this, but I do know it's a pretty safe investment option. Cryptocurrency, I know zero about it, other than it intrigues me the way it's working, and it intrigues me the number of people that I know personally that have invested in this. Working for a bank that we use currency, U.S. currency, as our medium of exchange, it's difficult for me to get my mind around how this works. I'll probably be the one left out in the rain when everybody else is making millions of dollars because they invested in it, but I really can't talk very intelligently to it. In commodities, this This is gold, cattle, soybean. There is a market for those type of agricultural products, and they're normally investing in the future price of these particular things. Precious metals, agricultural, livestock, energy, crude oil, petroleum products. You can buy future contracts in these commodity products. Bottom line, there are a lot of types of investments to choose from. Some are perfect for beginners, while others require more experience and knowledge. Each type of investment offers a different level of risk and reward. Investors should consider each type of investment before determining an asset allocation that aligns with their goals. Investing tips. Set investment goals. Just like the diet thing I talked about earlier. Decide exactly how much money you want to make. Honestly. And you can't use ambiguous words like all I can make. You really need to have a goal. So it will help. You can track it. You can grade it. You can keep monitoring it. You just can't simply, I'm just going to make money. You really need to have a goal, and you need to have a set time that you're going to make that goal. Invest early, today, not tomorrow. Because why? Tomorrow never gets here. Tomorrow never comes. Make investments automatic. What that means to me is have it set up to where on payday you have an electronic debit, pull out $50 and send it to your investment account, and it just does it automatically. So it does, and it does it on payday, so you never see it. It's gone, but you really don't know it. But it's going into your investment account to help in each and every month on payday build that fund. Learn about investing. Talked about how important knowledge is and being informed. Set up retirement accounts. Retirement accounts can be an investment account, just like just a regular investment account. So you need to set this up. And the benefit of a retirement account is it's tax-free or tax-deferred. A regular investment account is a taxable event. It's called capital gains, short-term and long-term. But a retirement account is going to, the idea of it is to set up an account that you'll use later on in life, and your tax level is much less. Be wary of commissions, and this is something that's hard to determine, and it's almost you have to do business with them because they don't disclose it all. There's hidden fees and hidden commissions with some of the brokerage firms. You just got to be careful that you're not wasting money through commissions. Diversify your investments. Again, talk about trying to mitigate risk. And the way you do that is diversify. Buy 40 or so investments. Study your portfolio. Know what you got and know why you got it. Study your portfolio. Well, I just bought it because someone said it's a good idea. That's not studying your portfolio. You need to look into the background of the companies, how long they've been there, how they make money, have they had financial issues or not. Are they a green company? Know where your money's going and why it's there. Keep informed. So there's a couple different ways that you can invest. You can go online and open an account, and you go to their website with your PC, and you can day trade or whatever. But if you don't have the luxury of being able to sit in an office behind a desk and have that computer and that website, there are apps out there that I think, and these are, in my opinion, some of the best, and they're ranked best to least, or first to last, whatever. But it's based upon a rating, consumer rating by reviews. It's based upon what it costs to invest, if anything, and it's also rated by freedom to invest. Is it very restrictive, and you only buy certain things, or can you do the whole gamut? So SoFi Investments is probably one of, I don't use them myself personally, but they are one of the best from what I've read and looked into. Zero trading and no cost to have automated investing payments made to your account. Free active trading and automated investing. Very good, I think, very good app. The next is Ally Investment. It was rated pretty well. Zero trading, but it costs you have to have $100. It won't just automatically transfer $5. It has to be a minimum of $100 for automated accounts. low-cost investing and banking features. And when it says that, these are the commissions and the fees that you need to be careful of and read the fine print, because, and I didn't take the time to do that, but this is where you might get caught having to spend money that you don't want to. Acorn Investments, $3 a month or $5 a month, hands-off investing. They kind of let you do pretty much what you want to do, which means that they'll allow you, for you to be an option trader or for you to be a commodity trader without really having the experience is one of the best ways to lose money in the market. But these folks will let you do it. TD Ameritrade, which is one that I personally use, it has a little bit of a cost, but all around trading and investing, I mean, you can do pretty much what you want. They do have levels of approval for the kind of investments, but there's a lot of information. They do a really good job for research and providing research for you. I mean, I prescribe to them, but I think after I've read about SoFi, that's probably better. But anyway, Public, Zero Trading, free stock, ETF investing. It's very limited, not very well known of, but it's not a bad rating. And then Robinhood, Zero Trading, and you can do all the active trading you want to do. It doesn't have all the features that SoFi does, but it has more than Acorn, Ally, and Public. And then Stockpile. I threw this one in because Stockpile, even though it's not really rated well, this is a great app for children or teenagers. It lets you do fractional investing. You can buy a quarter of a share of Microsoft. You can buy gift cards that have fractional gift cards that allow them to buy stock, put it in their account and buy stock, commission-free investing, and you can even open up tax-free custodial accounts. SoFi, the top pick for beginners, thanks to an easy-to-use platform paired with rock-bottom pricing. You can get started at SoFi Invest with just $1. There are no commissions for trades and no recurring account fees. Even the managed portfolio product, SoFi Automated Investing, where your investments are all picked and managed for you, is free to use. And this really is a good app. In addition, cryptocurrency trading for Bitcoin, is it Dogecoin? And more than 27 other coins. You can also access investment and education articles from inside the app. As an added bonus, outside the app, SoFi offers a complimentary financial planning sessions for all its members, among other benefits. It really is, I think, one of the best. Robinhood is a pioneer in the non-commission brokerage model. It remains a solid choice for beginners as they can invest in stocks, ETFs, and options with zero commissions. Typical stock and EFT investors will be able to use Robinhood with no cost at all, though premium accounts are available with more features for a monthly fee. So what happens is, and this isn't a high cost, but we'll let you do so much for nothing. And then if you want to do a little more complicated stuff, we're going to start charging you. And then there's levels of that, and that's where you need to be careful about spending money on commissions. Robinhood offers commission-free cryptocurrency trading for several digit assets. However, Robinhood has a history of controversies over downtime and how some users have been able to enter extreme risky trades that they didn't understand. And then I think I did a little bit of the next one, please. Stockpile. Stockpile also offers commission-free stock, EFT trades, and provides some unique features that complement its zero commission free structure. Stockpile allows fractional share investing and supports the gift of stock through gift cards, which makes it perfect for your youngster investors. If you are a parent, grandparent, aunt, uncle, or another relative who wants to help a child in your life learn how the stock market works, Stockpile is perfect for your needs. And we're at the end of the deal, but I saw this and I think it's hilarious. Who said crypto is stressful? I'm 21 and I feel great. Little disclaimer, in case anybody reproduces this, just understand that this is all personal opinion and preference. But that's the best I know and can tell you about investing for beginners. There's so much more out there, and again, I encourage you, if you're going to invest, to build your platform of information, be ready to know as much as you can know about it before you take that first step. good luck, and I wish you the best.
Are there any questions?
Oh, are there any questions? I'm sorry. We good?
So get it over with.
Stacy, got any questions?
No, sir.
Okay, good. Thank you.
Okay.
Thank you.